Joining us. We'll get started now. So welcome to this week's episode of Trending Treasury, where we'll have a market update. Where are we now from Vanguard, where we've got Shaan Raithatha here. He's an economist and strategist for Vanguard. Welcome, Shaan. How are you this morning?
Thanks, Stuart. I'm very well, thank you. And thank you to you and Arlene Close for having me on today.
No problem. I see you've actually put up your official Vanguard background. I must say I quite liked your lion beforehand.
Yeah, I thought I'd be a bit more professional this time.
Well, thank you for joining us. We've got a number of topics to cover. We'll sort of cover off Brexit, the US elections, and a bit of COVID. So we'll kick off with a bit of Brexit. Where on earth do you see the year ending? Sort of what scenarios could you tell us about?
Yes, I guess this topic has been slightly forgotten amid the US election and everything going around COVID. And, of course, the UK and the European Union are still trying to reach an agreement on a skeleton free trade agreement. As most of you will know, all sorts of deadlines have been missed into the run up to this point. We had that 30th of June deadline to get a deal struck, which since has passed. We also had the EU summit on the 15th, 16th October, which also, I guess, was a null event in the end. And maybe in hindsight, at least in the benefit of hindsight, this was really to be expected because all deals you at the very, very last minute, and we have precedents for this. Given how negotiations with, for example, Greece went when they were restructuring their debt a few years ago, and also earlier rounds of negotiations with the UK on Brexit, including the negotiations around the withdrawal agreement. So the key issues remain that of fisheries, level playing field provisions, and state aid. Both sides have so far been unwilling to compromise on these issues, but at least in the Vanguard view, we think there actually is room for compromise from either one or both parties, and we think actually one or both will budge eventually, and that could happen even as early as next week. So first on fisheries, for example, one way a compromise could be met is if the EU concedes that fishing quotas do not have to remain exactly as they are forever, which is not too much of a big deal from their side. And on the UK, they could agree that quotas could be revised gradually over time rather than immediately, which could be quite a nice middle ground. And the similar thing could go on with level playing field arrangements as well. So there is scope for the EU to allow the UK's own supervisory bodies to have oversight on standards as long as the UK agrees to these things called non-regression clauses, which essentially ensures standards will not be weakened over time. So in our view, we think a deal can happen, and actually we think it will happen as well. And the chances of a deal being struck have increased slightly following last week's developments where Dominic Cummings and other traditional hard Brexiteers have left Boris Johnson's inner circle. So we actually think news on this will probably come in the next week or so. Given you still need a bit of time before the end of the year to get this ratified through the European parliamentary process. Now, the interesting thing is, actually, in terms of the medium or longer term outlook, and we've illustrated this on the right-hand side chart here, that the difference between a bare bones free trade agreement, which is really what's being pitched at the moment, and no deal, isn't actually that large. Both will actually result in quite meaningful falls in both productivity growth and supply growth over time, at least according to our estimates. And so, although maybe this issue has been put on the back burner slightly of late, in our view, the crunch time really will happen in the next couple of weeks, and so you could expect some market volatility on the back of that as well.
Brilliant, thank you very much. So moving on to the US election, the thing that's been dominating the news recently, sort of, what do you see in terms of the happening at the start of next year, sort of when Joe Biden is inaugurated on the 20th of January? What's the first thing he's going to do?
Yes, I mean, I think the first thing to say is we do think that will happen. We do think Joe Biden will be inaugurated as the 46th president of the United States on the 20th of January, despite the various legal challenges by Trump and also, a recount or two that might happen in certain states. I think what Biden will do immediately actually depends not so much on, well, it obviously matters whether he is president, and we think he will be, but it also matters what happens in the House of Representatives and the Senate. So the Democrats are pretty much nailed on to hold the House of Representatives. But in the Senate, we actually won't know who will have control until early January. And that's because in the state of Georgia, no Senate candidate up for election this time round polled more than 50%, which is a requirement under state law there. And so there'll be runoff elections held on the 5th of January for both of Georgia's Senate seats. And this is important because if the Democrats win both of those seats, then they will have 50 out of the total 100 seats in the Senate. And in the event where there's a tie in the Senate, the casting vote goes to the vice president, who of course is Kamala Harris, who's obviously a Democrat. And so in effect, if they win both those Georgia seats, the Democrats will have control over both the House and the Senate, and therefore will be able to put forward a much more ambitious program of, say, fiscal stimulus, reform, tax cuts, regulation, etc. Now, according to the betting odds, which maybe one would argue are more reliable than the polls, at least in recent years, the Democrats will only win one of those seats and the Republicans will win the other. And if that happens, then there's likely to be continued gridlock in Congress. And so actually Biden and his team will be relatively constrained, similar to actually Donald Trump and also Barack Obama in their previous terms as well. We do think a fiscal package will come sooner rather than later. And I think that decision has now been made easier with the development of a vaccine, which we'll talk about a bit later as well. But because of the vaccine announcements, we now have an endpoint in sight, or at least closer. You can see it a bit more visibly now. And that makes it easier to then pass through a shorter term fiscal stimulus package, because one of the concerns was, if we do this, how long will it last for? But saying that the stimulus package is likely to be a bit smaller than the Democrats would originally have liked, given this continued gridlock in Congress, but also arguably there's less need to do a $2.5–3 trillion fiscal package now that perhaps the pandemic, you can see the endpoints at some points, maybe in the middle of the end of next year.
Okay, and if there is one seat allocated to the Republicans and one to the Democrats, Joe Biden is known for sort of maneuvering the Senate at least a little bit and the House. Do you think that would help him, or do you think the Republicans will stay sort of steadfast in their anti-Democrat views?
Yeah, I think it's very difficult to see a scenario where the Democrats can pass through, or at least Biden's team can pass through everything they want without significant objection and significant obstacles in Congress. Even if the Democrats win both those seats in Georgia, it's not a foregone conclusion either, because you do have some Democrats within the party who are slightly more Republican in their tendencies as well. And you also have this filibustering arrangement in the US, where essentially people go up and speak and run down the clock, as you have in the UK as well. And so you really need a majority of, say, 60 to 80 people in the House and Senate to really get things through without any problem whatsoever. And yes, so this slide here really talks to, I guess, the view that with the Biden presidency, you probably will pivot towards something which is perhaps a bit more orthodox and closer to the status quo. But crucially, there are some issues where actually things may not change at all. And so this slide here is admittedly a very early attempt to plot where Joe Biden falls on a variety of foreign policy issues on the Obama-Trump spectrum. And so on the left, you have a stance which is closer to what Obama would have done, versus on the right, a stance which maybe is closer to what Trump would do. And again, this is quite tentative, but we know from on the climate change issue, Biden will rejoin the Paris Agreement and will target zero net emissions by 2030. Not as ambitious as other Western economies, and not even as ambitious as China, but still better than the Trump stance of actually pulling out of the agreement altogether. On Europe as well, we expect closer working arrangements on key strategic foreign issues, whether that be intelligence sharing, defense, technology, investment, etc. And clearly Biden is a strong backer of NATO as well. But perhaps the one issue where Biden maybe is a bit closer to Trump than Obama on is the issue of Brexit. Biden actually has Irish roots as well, and so any signal that the UK will deviate from the Good Friday Agreement and risk a hard border between Northern Ireland and the Republic of Ireland could lead to dramatic ramifications from the US's point of view on future trade and a future trade deal there as well. Then on the Middle East, actually Biden is a bit more similar to Trump in that he wants to step back from intervention in that region, although he has promised to rejoin the Iran nuclear deal, assuming Iran does come back into compliance with those terms and arrangements initially made under the Obama administration. And the big foreign policy question mark is on China, where it's actually unclear what is going to happen, because in recent years, and perhaps helped by what Trump has done, there has been growing skepticism among US politicians, not just the Republicans, but also the Democrats, about what China is doing and how much they're getting away with. And that has also been mirrored by similar sentiments in Europe and most of the US's Western allies as well. And I mean, Biden will be less aggressive publicly on China relations, but I'm not so sure that privately he's going to take too much of a step back. And it's quite likely that he won't even reduce existing tariffs that the Trump administration implemented, and instead he might use them as bargaining chips to try and gain a bit more leeway in other issues such as technology, investment, and other things similar to that.
Fantastic. Yeah, it sounds like tariffs aren't going to be the tool of choice for the Biden administration, but merely a bargaining chip, which is encouraging for the rest of the world, at least. And how do you see this impacting markets?
Yes, I mean it's a good question. I think a couple of things to pull out in the short term, at least. First, on that left-hand side chart, up towards election day, you saw a slight steepening in the yield curve. And so from, say, the beginning of October, the 10-year Treasury yield was just below 70 basis points. It had ended quite close to 90 basis points by the time election day came around. And that was really reflecting expectations of a clean Democratic blue sweep where they have control over both the House and the Senate. And so they can really put forward a big fiscal stimulus package. When it became apparent that now seems more unlikely than not, the expectations of that fiscal stimulus package started to reverse, and you saw a flattening of the curve, and you saw the 10-year yield back down to 75 basis points or so. Now, since then, you've seen a slight reversal of that move, but that's really driven by the vaccine news and less about the election. And on the equity side, actually, equity markets, not just in the US, but globally, have had a pretty good time of it, really since election day. And that's really driven again by two things. One is the US election itself, which, okay, yes, you have a bit less fiscal stimulus, but the Biden and Harris administration were threatening to increase regulation, particularly on big tech and pharma, and also increase tax rates, mainly on the corporate side in the forms of dividends, corporation tax rates, perhaps close down a few tax loopholes as well, but also an income tax increase for the highest earners in the US. And so the fact that is now less likely to happen because of expected gridlock in Congress actually led to a very sharp rally in US stocks. And in particular, the technology sector outperformed by, I think, around 3 percentage points on the week following the US election. So that kind of explains part of that move. And then really the second leg up has been driven by the positive vaccine developments as well.
It's very interesting. As you say, the vaccine news has been welcomed by everyone, and more than one vaccines is fantastic. If we just move onto the impact of COVID, sort of looking at the UK and the wider world economy, what do you think about the impact of lockdown 2, as it were, on growth specifically?
Yes, of course. So, I mean, I think actually this is obviously the most significant and important thing in terms of the economy and growth, but also financial markets. More important than the US election, and more important than Brexit. And just to put that in context here, we have these charts which show the number of daily cases per 100,000 of the population across 4 of the main regions of the world. And one thing to clearly identify here on the top right chart, you have the European cases, which are just soaring. I mean, France is leading the way, Italy, Spain, and the UK not too far behind, and the R rate is clearly well above 1 here. But you'll also notice in the bottom left chart, it's also taking off in other parts of the world, especially in the US. And this is important for the economy, especially in a presidency where he's clearly framed tackling COVID as the main priority. And so he may be a bit more, I guess, restrictive on what people can do than under a Trump administration. And then on the other 2 charts, top left and then bottom right, you'll see the virus is relatively contained, although in places in Latin America, the data may be less reliable. And if we just go to the next slide, perhaps one of the reasons why the government's only acting, has only acted in the past few weeks is really because you're now seeing a much bigger strain on hospitalizations and on death rates. The case count's been a bit skewed because we now have the availability of mass testing data. And so, you can't really compare the first wave to the second, but what you can compare more closely like to like is number of hospitalizations and the number of deaths. And now we're getting to above half, if not 2/3. These charts are slightly dated now, of the daily hospital admissions and daily death peaks that we had in the first wave. And so, we've had tighter restrictions announced in the past few weeks. France and the UK have announced national lockdowns. Germany, Italy, Spain have also announced much tighter restrictions, albeit stopping short of an outright lockdown. And I think the first point to note when we talk about the impact on growth is that the overall stringency of these measures is expected to be slightly looser than what we had in the spring. And the next slide shows you that via the Oxford Stringency Index, which is a measure of how tight or how loose restrictions are nationally. And if you want to focus on the orange line here, which is the index for the UK, you saw, we're actually getting to the levels in the spring, but it's still slightly looser, but it is also much tighter than what we had in the summer. This is important because relative to the sharp contraction we had in spring, it's going to be a bit less severe. And that's because sectors like construction, manufacturing, the housing markets, and also schools are still going to be open, and mobility is going to be less restricted. And schools, it might sound like quite a small thing, and it only accounts for maybe 1 or 2% of GDP in the education sector, but it's also important in the second order because when schools are closed, many parents are forced to not go into work because they're looking after their children. So by allowing schools to open, the parents are also then more free to enter the workforce and contribute to the economy. The second factor, in addition to stringency, which is important for calibrating the impacts on growth, is how long these measures are going to last for. Now, in the UK, we've had this national lockdown, which is meant to end in early December. But in our view, actually, we think it's unlikely that the number of cases or hospitalizations or deaths will have fallen significantly by then, to justify an easing of restrictions, given the lag times involved with restrictions on these factors. So in our base case, we actually expect the current measures to be in place until at least mid-December. Might be slight relief for Christmas, but then if there is slight relief, we expect those restrictions to be put back up again after the new year. And so overall for the UK economy, and the next slide kind of illustrates our expected path. We expect, or apologies, the slide after that, and this is about the vaccine. We expect UK GDP to fall by around 4% for the fourth quarter, which is much shallower than the 20 to 25% fall you saw in the first wave in the second quarter of this year. And then it's primarily for those two, really the reason that stringency is going to be much less strict than it was in the first wave, but also a couple of other reasons, including the fact that you're starting from a lower base here. Restrictions were already in place before the national lockdown got introduced, and so the delta or the change in restrictions is a bit smaller than what we had earlier in the year. But also there's now evidence that lockdown restrictions are having less of an effect on people's mobility as they were doing back in the spring. And we know that mobility is highly correlated with economic activity. And we don't really know why this has happened, but it could be because people have adapted better. I mean, for example, people that didn't have a car and who live in cities now do have one and can move around a bit more. Also, people might now be becoming more confident in going to a shop now that mask wearing has become mandatory, or that shops now have better cleaning and social distance protocols. But it also could be that people are just a bit fatigued with lockdown and just generally less compliant, which obviously is bad for virus containment, but is a positive for short-term economic activity, especially relative to what we saw earlier in the year.
Brilliant. And so your expectation of a 4% decline in growth, that was just in the 1 month, wasn't it?
No, that's for the quarter as a whole.
Okay, fantastic.
So we do expect maybe a 5 or 6% contraction in November. October pretty much stagnated, and we think the restrictions will last for the large part of December as well. And so that's why you get the 4% number overall.
Okay.
And clearly with these restrictions on board, you also then require more stimulus to help support the economy and bridge until we get back to something which is a bit more normal. So on one hand, you have central banks actively ramping up their QE purchases. And that left-hand side chart there just shows you the context of how large central bank balance sheets are getting, especially relative to what we saw in 2008, 2009. And by central banks purchasing all these assets, this then enables governments to expand their fiscal policy in a much more effective way, because they just don't have to worry about borrowing costs, at least in the short term. And so you're seeing kind of record levels of fiscal deficits this year, and you'll probably get quite large deficits next year as well as this pandemic spills over into 2021. And to be honest, it's kind of been effective. So I think the next slide will show you what's happened to unemployment across most European economies, including the UK on the right-hand side there. So the red bars show you what we expect the peak rate of unemployment will be cycle as a result of the coronavirus crisis. And the blue dots show the unemployment rates peak over the last 10 years, really since the GFC. And in some of these countries, the peak didn't occur straight after the GFC, but it occurred after the Eurozone debt crisis, between 2012 and then 2014. And these measures have been very effective in putting a cap on the unemployment rate. And that's very important in terms of the recovery looking forward into next year, because the more people that can keep their jobs and the less labour market scarring, or the less people are unemployed for the longer term, the greater the rebound and the recovery going forward.
Fantastic. And you just touched on the expanding of balance sheets from the Bank of England and the Fed. How much do you think this contributes to sort of asset price inflation rather than helping the real economy?
Yeah, it's a good question, and I think this question has been around really for the last 10 years since QE started back in 09. I think clearly in 09 that was the experience, right? You saw a big compression in interest rates and risk premia, which tends to inflate valuations across the risk spectrum, whether you're looking at investment grade corporate bonds, high yield corporate bonds, equities, or even kind of the riskier the equity universe as well. I think this time around it's slightly different. One, because interest rates across maturities were already very depressed prior to this crisis. And so QE programs this time haven't really done so much to lower what you'd call term premium or duration premium on the government's bond yield curve. And also, to the extent that these QE purchases is actually funding government deficits, now the money which is being printed in some ways is more directly going to households and to companies and into their bank accounts rather than into financial markets per se. And so I would argue this time around it maybe has less of an impact on asset price inflation, but probably certainly less of an impact on inequality because you're going through the fiscal channel a lot more than just through financial markets.
Interesting. And you touched on it there. The interest rates were already low when this expansion started. Do you expect them to stay low for the duration of the next year or two or three?
Yes, I mean they will certainly stay low for the next year or two. Just in terms of natural sequencing of things, most central banks have already committed to continuing their emergency QE programs for at least the next 9 months or so, and it might even go on until the end of 2021, at least in the Bank of England's case, and possibly the European Central Bank as well. And typically central banks would be they would be averse to raising their policy rates until their QE programs have at least stopped and maybe even started to reverse slightly. And I guess there's no rush as well. A trend among central banks to move away from simply targeting 2% inflation at any given one point in time to a more symmetric target where they now take into account previous years' shortfalls in inflation and then maybe a bit more tolerant to inflation in the future to try and average 2% inflation over a given period of time rather than just focusing on one point. So central banks will be patient here. They'll encourage inflation because of that point, but also because debt burdens are also slightly higher now, and so a bit of inflation is quite good to try and erode that burden. So we do think interest rates will be low and definitely lower for longer relative to if the pandemic didn't happen. But we do expect them to normalize eventually as inflation pressures do creep up.
Fantastic. Brilliant. And so we'll just touch briefly on the markets for the year ahead and further. So what asset classes do you think have the greatest potential over the next sort of 5 to 10 years, if any?
Yeah, I mean, so the way we try and answer this question at Vanguard is we've built a model which is called the Vanguard Capital Markets Model. And what it does is it takes the historical relationship between financial market asset class returns and a number of economic fundamentals, whether that be GDP growth, inflation, interest rates, but also things like financial market volatility. And we then make assumptions on where we think those fundamentals will be in, say, 5, 10, 20 years' time. And with that, we can use those relationships to then project forward how returns are expected to evolve over the medium term. And what we also are conscious of doing here is not just providing a point forecast, because we're inevitably going to be wrong. No one can predict with that kind of level of accuracy. So we also want to try and provide a distribution of a range around those potential outcomes. And so the next slide here shows you our expectations for asset class returns across the risk spectrum. So these are box and whisker plots. So you have that white bar in the middle of the plot there shows you our median expectation for these different portfolio mixes on average over the next 10 years on an annualized basis. So for 60-40 portfolio, we expect on average a 4.5% return a year over the next 10 years. But we know that's probably going to be wrong. And so we also have an interquartile range, which is highlighted by the red area there, which shows that we're probably going to look at returns of around 3 to 6% for 60-40 portfolio over the next 10 years. And then the whiskers of the plot are the 5th and 95th percentiles. And as you can see, if you pivot more towards taking on greater risk on the right-hand side of the chart, and you have just 100% global equity portfolio, we expect returns of around 6% a year. And if it's closer to bond, you're expecting returns of maybe 1.5 to 2% a year. And in terms of how those metrics have changed over the course of the last 12 months or so, the next slide will show you that journey. And a big part of this is driven by how valuations have changed. So at the beginning of this year, we had a 60-40 portfolio giving you around a 4% return on average. Those return expectations jumped significantly at the height of the crisis, when clearly equity valuations plummeted. And so you had maybe a 5 to 6% return driven mainly by that equity component. And now we're seeing a return which is maybe halfway between the two, which reflects valuations being halfway between the two obviously relative to those two data points, the beginning of this year and also the peak of the crisis in March. Equity valuations have improved slightly, mainly because things have just sold off. But on the bond side, your expected return for bonds have lowered slightly because yields have fallen. And so if your starting yield is lower, then you obviously expect a slightly lower return going forward for the next 10 years or so.
Very interesting. Thank you very much for joining us, Shaan. We've sort of reached the end of our usual slot, so that I found that very interesting. If any clients do happen to have any questions, please forward them on to us, and we can forward them on to Vanguard for any further queries. Just a final note, next week we have another webcast, Better Forecasting in the Public Sector, with Michael Story from maybe.app. So final thing to say, thank you very much, Shaan, for joining us, and we'll see you all next week.
It's been a pleasure.